Having a solid risk plan, regardless of what your time frame is when you're in the market, is so important. Understanding that a recession and a negative bear market is going to increase volatility requires maybe a revisit of your risk plan. Guys, let's talk a little bit about 3 ways or 3 tips we'll give you here in this video on how you can control your risk even in these volatile markets.
My tip is going to be about the most simple tip ever. And it's one thing I talked about today when going over actually the Tesla trade that I know almost everybody was in. And that is simply start from a standpoint of where is my out when I'm trying to structure a trade. When you have increased volatility, it's not necessarily about getting the direction correct. It's being able to accept where I'm going to be wrong and being able to limit the downside in the trade. Because there's lots of ways that you could have won in some shorts today, let's put it this way. Like you could have won in some shorts today, but you had to have a sound understanding of what you were going to do if it went wrong. Like if you had a 780, like, oh, I like shorting 780, but I'm only willing to risk a couple of dollars on it. So you're not shorting 765 with a 780 stop. That 780 would be correct, but it never gave you a chance to work. And so if you understand that I am wrong on this stock if it gets to 780, and then you can structure your trade from that standpoint. And I think this is one thing that I talked about even when I was looking for long opportunities in the stock. I started from, well, where are my outs going to be? And if when I wanted the long, my outs had to be in the mid-80s, then I had to structure the trade accordingly. And I think it's one of those situations where if you're taking that, it's a breakout style trade. When I was telling myself you're not wrong till 778, then I needed to be long in the 780 range. So start with where am I wrong first. That allows you to ask yourself, how much am I going to risk in the trade so that I can control my losses? Because you can have a good trending move, but if you can't get into a trade that you are able to hold for the winner, then everything is moot. And the more volatile the market gets, sometimes it's about understanding the risk structure so that you can be in the trade when it's a winner. It doesn't matter if you liked it long. If you got wiped out because you misjudged your risk, then everything is completely a moot point. Calling the direction is not good enough. You have to be able to execute the trade. And that means determining where you are wrong first, then taking the trade and structuring everything else from there.
Booyah, we love structured trades around here for sure. So that's a great tip there. When you're in these volatile markets, have a structured plan before you even enter it. Look, mine is going to be familiarity. Yes, I said it right. I didn't want to have to retake that one. And what I mean by that is be familiar with the stocks that you're trading in these environments, right? Because you don't want to go over to a brand new name. Like if it's a volatile market and maybe you've never traded Netflix before, or you've never traded Apple before, or Microsoft, or it doesn't matter the name, Nucor today on earnings, something like that. If you're not familiar with the stocks that you're trading, then how could you possibly judge the risk that's associated with them, right? So I'm just gonna go over a couple names here just to show you what I always do, man. I mean, Apple, we're in it today. Look at this nice winner. That's a $2 winner. We're very familiar with it. And it doesn't even matter. I'm up on Amazon, but look at all the trades we've had today. These are all shorts, right? Into a ripping market. So you got to be able to pick your spots and understand the way that you're going. This has nothing to do with what Neil was saying, structure your trade. It's like trade the names that you're familiar with, and then the structure will be a little bit easier for you. I've watched Amazon since the split, understand some of the moves, understand where the risks are, right? I mean, that's something else. I haven't traded Google today, but for example, here's another one. I rarely trade Tesla. Okay, so today, why don't you see like so many ins and outs? Tesla today, 40 million shares. It's reported, it's great. I guarantee you when Apple reports or Microsoft or Meta or any of those names report, I'm gonna have more. And look, this is an $11 winner. It's all good. But the point is that I don't really trade Tesla. So I'm not familiar with the scalping or anything like that. So to me, the question is how do you control, the risk and whatnot in volatile markets? To me, it's trade names that you're familiar with. Don't be afraid to go over where the action is, okay? But put a lot of the risk and stay in your lane. That's my tip.
Point, when you look at the same thing on a daily basis over and over and over again, Familiarity, Sean, I love that word. I'm going to show you an indicator, actually, that can help in these markets as well. And that's at the bottom of this screen. That's average true range, or ATR, if you're seeing that for the first time. This is just the SPY. The stock doesn't matter. You can throw anything up here, but I want to draw your attention to the beginning of this year, because all that has happened since the beginning of this year is the average true range of the SPY, in this case, has done nothing but go straight to the upside. Yes, we're coming off a little bit now, but if you're used to trading a stock that trades in a $3 to $4 range, and you come and look at it for the first time, possibly when it's trading in a $10 range, your risk is obviously going to need to be adjusted accordingly. So an easy way to get a visual, very quick visual representation of what can be expected in the day's range on the stock that you are looking at, and then you can judge your size and risk accordingly. There's 3 great tips, guys, on how to control risk in these crazy volatile markets.